Welcome everyone. Today I'm going to show you one of my favorite intraday trading strategies, the 15-minute opening range strategy, also known as ORB. The first 15 minutes after the market opens are usually the most volatile period of the trading day. This is when institutions, hedge funds, and retail traders are all placing orders simultaneously. Instead of chasing the market, we're going to learn how to read this initial price action and use it to find high-probability trading opportunities. So what exactly is the opening range? It's simply the very first completed 15-minute candle after the market opens. Once this candle closes, it gives us two important levels: the highest price reached during those 15 minutes, the lowest price reached during those 15 minutes. These two levels become our reference points for the rest of the trading session. There are two ways traders generally use the opening range. The first is the classic breakout strategy. Here traders expect price to continue moving after breaking above or below the opening range. The second approach is the reversal strategy. This assumes that the first move was actually a liquidity trap and price will reverse back into the range. Today we'll look into both. We never enter a trade simply because price reaches the opening range. We wait for confirmation. The two confirmation patterns I prefer are hammer candles and engulfing candles. These candles show that buyers or sellers have taken control after the initial manipulation. Without confirmation, we're simply guessing. Let's look at the complete workflow. The process is actually very simple. Market opens. Wait for the first 15 minutes. Mark the high and low. Determine whether the opening move is manipulation. Switch to a 5-minute chart. Wait for confirmation. Finally, execute the trade. Following the same process every day removes emotions from trading. This is where most traders make mistakes. A manipulation candle is a very aggressive candle that moves rapidly in one direction. It creates fear. Retail traders usually think the market is taking off. They jump into the trade. But very often institutions are using that move to grab liquidity before reversing the market. Our goal is not to chase this candle. Our goal is to identify it. So how do we know whether a candle is actually manipulation? We use average true range, or ATR. Take the daily ATR. Calculate approximately 20% of it. If the opening candle has already consumed more than 20% of the day's expected movement, there's a good chance the move is overextended. That increases the probability of a reversal. Let's look at Meta. Suppose Meta has a daily ATR of $16. 20% of that is about $3.20. Now imagine the opening candle itself moves $15. That's almost the entire expected daily movement in just 15 minutes. This tells us the move is extremely aggressive and likely driven by institutional activity rather than normal price action. Now let's see how to trade 15 minutes reversal. Once the first candle closes, identify the manipulation candles. Then draw two horizontal lines. One at the high, one at the low. These levels become today's battlefield. Most institutional decisions happen around these levels. Throughout the day price will often react here. Now we switch from the 15-minute chart to the 5-minute chart. Why? Because it gives us a much better entry. Instead of buying or selling blindly, we wait for confirmation. For example, a bullish engulfing candle, a hammer, or another strong reversal pattern. Here we see the inverted hammer, often called as shooting star, and engulfing at the retest. This is our confirmation. We enter at the close of bearish engulfing, stop loss at the top of the candle and target at the candle opposite end. Not every opening move reverses. Sometimes the market genuinely breaks out. In those situations, we wait for the breakout above the opening range, look for confirmation, enter on strength, place the stop below the breakout level, and ride the momentum. The important thing is that we're still waiting for confirmation instead of blindly buying the breakout. The breakout workflow is almost identical. Wait for the first candle. Check whether the move is genuine. Once the first candle closes, draw two horizontal lines. One at the high, one at the low. Now we switch from the 15-minute chart to the 5-minute chart. We'll wait for confirmation exactly like the reversal trading. Difference is in spite of reversal candle, we'll look for continuation candle. We'll enter at the close of the hammer candle created on the top of opening range, stop loss below the hammer candle, and target our next liquidity, FVG or order block. A great strategy without risk management still loses money. Always follow the 1% rule. Never risk more than 1% of your capital on a single trade. Always place a hard stop loss. Only take trades where the potential reward is at least twice your risk. Remember, professional traders focus more on protecting capital than making money. Here's how the entire strategy looks in practice. Wait for the opening range. Identify manipulation. Mark the levels. Switch to the 5-minute chart. Wait for confirmation. Enter the trade. Manage risk. Exit according to your target. Every trade follows this exact sequence. Consistency is more important than finding perfect trades. Let's finish by looking at the biggest mistakes traders make. Entering too early, ignoring confirmation, trading emotionally, not respecting stop losses. Professional traders do the opposite. They wait patiently, they confirm every setup, they manage risk, and they follow the same process every single day. This slide summarizes the entire strategy. Market opens. Wait 15 minutes. Mark the range. Measure ATR. Check for manipulation. Switch to the 5-minute chart. Wait for confirmation. Enter. Manage the trade. Repeat the same process every trading day. That's the edge. Before taking any trade, ask yourself these questions. Has the first 15-minute candle closed? Have I marked the opening range? Does the opening candle qualify as manipulation? Do I have a valid confirmation candle? Is my stop loss defined? Does this trade offer a good risk to reward ratio? If the answer to every question is yes, then, and only then, should you take the trade. Let's wrap up with the most important lesson from today's presentation. The 15-minute opening range strategy isn't about predicting where the market will go. It's about waiting for the market to reveal its intentions and then trading with discipline. Remember these 5 key principles. Wait for the first 15-minute candle to complete. Mark the opening range and identify key levels. Look for manipulation, not momentum. Wait for confirmation on the 5-minute chart before entering. Manage your risk with proper stop losses and a favorable risk to reward ratio. One thing I've learned is that the market rewards patience far more often than it rewards speed. Many traders lose money because they react emotionally to the opening move. Professional traders wait, observe, and execute only when the probabilities are in their favor. So the next time the market opens, don't rush into a trade. Let the first 15 minutes tell the story. Trade the setup, trade the probabilities, and most importantly, trade the reaction, not the emotion. Thank you for your time, and I wish you consistent and disciplined trading. Happy trading! If you like this video, don't forget to like, share and subscribe.